Rebel capitalists, I hope you're well. We've got my good friend and oil expert, Art Berman, in the house right now. Josh just put a link in the chat. So if you guys want to ask a couple questions to Art, go ahead and click that link. You'll get in the queue. And at the end of our discussion, we'll take a couple callers live. But let's go into that discussion, Art. Well, actually, first and foremost, if you could give us like a 30-second background of how you've gotten into the oil business and what you do now.
Sure, George. Well, I'm a working petroleum geologist. Most of my time I spend working for oil and gas companies, drilling wells, helping them understand what they drilled, and the commentary and the writing is something I do because it's a lot of fun, and maybe I spend a third to half my time doing it. So my perspective is a little different than a lot of people because I got my hands right in the middle of people that are doing the business as opposed to whatever guys with MBAs or and probably have never worked in the business. I respect them all, but just a different perspective for me.
Yeah, so you are in the trenches, boots on the ground. You're the one that's working with the people who are actually pulling the oil out of the ground. You're right there in Houston, ground zero.
Absolutely, yeah, yeah. Drilling wells, figuring out what we did right, what we did wrong, helping raise money to drill more wells. Yeah, that's what I love, and I got into it kind of by accident because I love geology, and that year they were hiring for oil. I figured, well, I probably don't want to do that, but I'll give it a try, and I did, and I've done it for more than 40 years. I love it. So
Yeah,
that's the story.
just on my earlier live stream, Art, I was telling the audience that you're the person who first kind of planted this seed of an idea that in my head that energy is the economy.
Right.
And just to put it in simple terms, if you have a reduction in energy, then you will have a reduction in economic output. It's just that there's no way around that, or at least the energy density of the energy source that we have available to us. So is there any way that
Yeah,
you could explain that to people in a kind of Reader's Digest version?
yeah, sure. I mean, it's true for all life. I mean, not that you can go talk to
Right.
a lion or an elephant or whatever, but his or her business is finding energy. It's finding stuff to eat. And if you're a lion, once you've killed something, then you can cool it for 3 or 4 days and sleep and have a good time, screw around with your pride or whatever. And if you're an elephant, you eat 23 hours a day. But life is about energy. I mean that
Right.
is the basis of all life. And for humans, subsistence living was not really very different than for a lion or for an elephant. For a long time, agriculture came along, and some people were able to accumulate a surplus.
Right.
And some guy said, "Well, I don't really feel like going out and digging a ditch or building a fence. So how about if I give you a bushel of wheat for my barn and you can do it for me?" I
Right.
said, "Yeah, I'll do that." And eventually it got to be a pain in the ass to be, hauling bales of wheat out to pay guys who were doing your manual labor. So money got invented, and money was just a call on a bushel of wheat or, whatever it was that the guy could eat because he wanted energy. And eventually we got so used to using money that we forgot that it was just a call on work. It's a call on
Right.
how a guy uses his energy every day. And now we think the economy runs on money. But when you realize that money's just a call on work, which is energy, then you realize that the economy runs on energy. And it's just that simple. And the
Right.
correlation between GDP and energy consumption, I mean, you couldn't find a more rock solid correlation if you look for it. Countries
Yeah.
that use more energy are richer. Countries that use less are poorer. And I mean, those are not value judgments. That's just the reality. And it's the same on the savannah. The big animals eat more, and the little ones eat less, and that's the way it works in the world. So it's nothing unique. It's not a theory. It's just an observation. We're so intellectually focused, we forget about the reality that underlies our lives.
Yeah, absolutely. And I just in this last story that I was doing, I actually let me pull it up here really quick. This we had I'm not sure who this gentleman is. His name Bill Snape or Snape, something like that. But he was
Hmm.
talking about Biden's plan or mandate for by 2050 to be carbon emissions neutral, and he says it's an extremely weak goal. And then he goes on to state that we need to make a commitment to be on 100% renewable energy by 2025. So basically 3 years. And my point there, and I told the audience I'd ask you before we get into your chart deck, that this may be a great objective, but there are going to be costs associated with that. And those costs would most likely be pretty unpleasant. So, what do you think that the top three costs would be that society would have to pay if we went to 100% renewable energy by 2025?
Well, first of all, it's impossible. I mean, let's just get that right out on the table. I mean, no, there's no amount of wishing or hoping or assuming everybody agrees that we absolutely need to do that. There's just no way in the world that's happening. I mean, it's just not
Right.
happening. So, I mean, it's a dumb idea to begin with. But um, the other thing is that I mean, renewable energy is great, and I'm all for it. I mean, it's where the growth is in providing energy to people, and it's going to be a part of the energy landscape for the rest of my life, your life, my kids' life. I mean, so this is not a partisan thing. But
Right.
as we talked about back when I was with your group in Miami in June, if you think about energy as a worker, okay, and you just compare, let's talk about electricity because that's what most of renewable energy is, and you have a worker that's a natural gas that represents natural gas, which generates an awful lot of our electricity, and you got a worker who's solar or wind. Well, it takes about 1,000 solar or wind workers to equal one natural gas worker.
Right.
So if
Right.
you run a business and you're an employer and you got to do a certain amount of work that uses a certain amount of electricity, I give you two choices. You want to hire one guy, you want to hire 1,000 guys. I mean, it's a dumb question, right? But that's really what we're talking about here. And people don't understand that. And they don't understand it because it's not their business to understand it. And that's fine. But there are big differences in performance, if you will, between different fuels. And the reason that we like oil as a civilization is because it's got the most bang for the buck in it. It's just that simple. It wasn't like a bunch of smart guys sat around and said, "Gee, which energy source should we use?" At one point we used animals and straw and wood, and sometime in the 1700s, some people said, let's try coal. I mean, we've got a bunch of it. It burns hotter, it's denser, and everybody slowly transitioned from wood to coal. And then oil came along, and slowly but surely, people said, yeah, this is better. It's like the lion. What do you want to go eat today? You can go out and kill yourself a marmot, or you can go kill yourself an impala, and the impala's 50 times bigger, and so you can sleep more if you get the Impala. Well, we use oil because it's more productive. It has better performance. And so to go to renewables, again, back to 1,000 workers versus one, it's just a whole lot less productive. And there's no species on Earth that has ever gone from a more productive to a less productive energy source.
Yeah, that was my next question.
So the idea that we're going to do it, and let's just say we all agree that we have to do it for the planet, and some people will disagree, but that's fine. We got to recognize it for what it is. We're
Yeah.
doing something that's never been done before, except when it's either die or live a poorer life. And that's the piece of this that people don't understand is that life in a renewable world, it'll be a poor, poor world, much poorer than
Right.
it is right now.
Right.
And nobody understands that that's what they're signing up for. Now, if we all agree that that's necessary and a good thing, then let's do it. But I don't think most people get it. And if
Yeah.
you tell people, hey, renewables are cool, but it's going to be negative economic growth, I think a lot of people are going to raise their hand and say, whoa, wait a minute, I don't want that. I can't
Yeah.
afford to make less money. And so, I think we have to be honest. We have to be truthful about what it is we're signing up for. So this plan, to go to 100% renewable by 2025, I mean, just forget it. Nothing changes that quickly on Earth. So that's not happening.
All right.
2050, no, I mean, it's impossible. I mean, you remember when we were forced to change from analog to digital television? I mean, 80% of Americans had already gone to digital TV. So we're just talking about 20% of the people that had to make this change. It was free. All they had to do was go someplace and pick up a box, and they had to keep postponing it like 2 to 3 years because people didn't do it. People just don't do what they're supposed to do. And somehow we're going to stop using coal and natural gas and oil in 4 years. I mean, it costs money. It's not going to happen.
Yeah,
So
and
we're
that
not going
and
to
the
do it
pol
by 2050 either.
yeah,
It
but
can't be done.
even the politicians that are pushing this narrative, they have no stomach for the downside consequences of their objectives. So, like as an example, Biden comes out and says, "Well, we need these objectives," but then as soon as gas prices go up to, let's say, $4 a gallon, $5 a gallon, now all of a sudden we need Saudi Arabia to pump more oil, fossil fuel, or we just need to go in our what is the reserves that we have, the
Strategic
national.
Petroleum Reserve.
There you go.
Strategic
Or we need to
Petroleum
access
Reserve.
that, which I think does nothing, but at least it's good theatrics, and just shows you how little tolerance there is for any type of downside to try to achieve these perceived benefits.
Well, that's because people get pissed if they have to pay $4 a gallon, and
Yeah,
Biden
right.
needs them to Biden needs them to vote for him and his party in a
Yeah.
couple of months. So, but there's a meeting going on in Houston right now. A bunch of big oil people. I don't know why they didn't invite me, but anyway, they didn't. But I read a couple of the comments by the CEOs, and this is one CEO of a company called Pioneer, and he said, "Well, Biden called OPEC, but he didn't call me. I mean, did he call any
Uh,
of you guys in this room, American oil producers? No, didn't call me either. Well, what's that about?
mm,
And he's, and again, this is not meant to be political, but he is the president, and he did say these things, and he's talking about how oil and gas companies don't have the right leadership. And one of the other CEOs of a company called Hess said, well, we don't have the kind of leadership the administration has because we actually have leadership,
yeah.
and the administration wouldn't take us.
Yeah.
Anyway, these are funny things, and we have to have a little bit of humor. But you asked me the cost, and the cost is astronomical. Okay,
Yeah.
but the task at hand is just so outrageous that I don't even mess with the cost. Let's just say cost is no issue. You just can't make these changes that quickly, and as quickly as you make them, it has consequences.
Yeah.
And most of the people pushing these agendas either don't understand the consequences or only care about one consequence, which is getting themselves reelected, and figure they'll have moved on to something else by the time everybody realizes that they were played, because that's really what it is.
Yeah. Yeah, I agree. That's really the bottom line. All right, let's go over to your chart deck that you emailed me, Art, and we can go through. This is your most recent newsletter. Is that correct? And so here's
That
where
is
we can kind
correct.
of get into the supply side, the demand side as you see it, boots on the ground, and then maybe try to figure out what prices might look like moving into 2022. So this, and I was telling Josh here, who's a big fan of your work, and he's a big fan of Snyder's work as well. And he was commenting the
All
other
right.
day. on the level of complexity with Snyder's charts. And I said, "Yeah, but have you seen Art's?" like, like he takes his charts to the next level. So tell us about this first one here. Can you see it? It's the WTI
Yeah, I
futures
see it
price.
fine, George.
Okay.
Yeah, so this is just the price of WTI, which is the West Texas Intermediate, the main North American or U.S. oil, which is in blue, and this is as of Friday, and it's moved up to like $73 since then. But you get the sense. And then the shaded stuff in there, that's just a simple two standard deviations above and below the mean, and something called a Bollinger Band, and it doesn't matter, but
Yeah.
it's used in stocks and lots of other things, and it
Yeah.
turns out to be a pretty good upper and lower limit of where we are and where we're going. And so where we are right now is we've dropped down to the lower limit. What's that say?
Mhm.
That says, well, the great likelihood is it's going to move up. And as I just told you, it's moved up $2 or $3 since I made this chart on Friday, and I've made a new one since. But that's fine. So
Yeah.
that just kind of tells you it went down a lot. People are all freaked out about this new Omicron COVID variant, and now they're getting a little more comfortable that maybe it's not as bad as we thought, and so
Right.
it's going back up again. That's all. Just kind of simple stuff.
Okay. So next one here, we've got Cushing working capacity reached a minimum the week ending October 29th.
So Cushing, Oklahoma is a place in Oklahoma. What a shock! And it is the pricing point for U.S.
Mm.
oil for a lot of reasons we don't need to go into. And what happens at Cushing is that when it's working capacity, which is to say, if you had to take everything out of the tanks except what sort of has to sit in the bottom, or else they you can't fill them back up again. That's working capacity. Cushing working capacity got real low, and as you can see, there's almost a perfect correlation between price in red and the capacity in blue. So it got low, price went up. It got higher, price went down, and as of today, we got a new report. It moved up a whole lot. It moved up a couple of million barrels. So what that says is that that the market looks at that volume and says, well, we it got scary for a while. We raised the price, and now it's looking better. So we're not with the urgency. A little bit of the urgency has been taken off, is what that says.
Mm. Okay. Yeah, I see. So the capacity has gone from a low of 34.5 to a couple notches up at 37.3. So that tells us that, let's see, the capacity reached a minimum so that minimum was 34.5. So that means it can't go any lower without risking the tanks themselves. So that
No,
mean
it can go lower. It's just that there's certain psychological levels that people, that oil traders and such worry about, and the
okay.
point is that I don't know. I haven't checked the capacity. I'm sure we're over 40% today with the latest
Mm,
report. So the pressure's off, at least for now, for Cushing. But
okay.
the pricing point matters. That's all.
Okay, so this next one, you're really gonna have to explain this one to me.
Well, okay, and for its complexity, let me just say that if you wanna know where the price of oil has been and where it's going, this is it. So
Great.
what this does is all it does is it compares how much oil we have in storage with how much the 5-year average has been, and cross plots that against price. And those two curves that you see, those are yield curves. Okay, it's a yield curve just like a bond yield curve, except that it's kind of flipped over because we're dealing with a comparative inventory and a price
Oh,
rather
yes.
than a yield and a maturity. But it's the
This
same concept.
but this is the yield curve you invented, right? I've heard you talk to Eric Townsend about this a lot, our good friend.
Right. Well, I didn't invent it. A guy named Mike Bodell invented it, but Mike's a good friend of mine, and he taught me how to use it a long time ago. He's kind of retired now, and So with his blessing, I've carried it forward. But
Yeah,
the
yeah.
point of all this is that you hear a lot of people, whether it's in the news or so-called experts, say, "Oh, I think oil's going to $100." Okay,
Mm,
well, what this yield curve allows you to do is say, well, if you think it's going to $100, I'm going to tell you how much inventory, how much storage has to be reduced to get there,
right.
because the relationship is pretty darn strong. And so you say $100 oil, I say you're going to have to use up, 30, 40 million barrels of storage before we get there. Well,
As
this
based on the
particular
numbers
week,
based on the numbers as of right now, Art?
yeah, yeah. So
Okay.
this week, the storage went down a little over 1 million. So I just kind
Yeah.
of pulled that 30, 40, out of thin air, but it's not too
Okay.
far off. And
Okay.
so it's got to go down at the rate it did today for 30 or 40 weeks before we get to $100.
Or demand
Okay.
skyrocket, right?
Well, yeah. So I mean, the point is that oil price is not something arbitrary that just sort of gets
Mm,
invented by a committee. Markets pay attention to this stuff, and
right.
if your storage is not getting low, just like we talked about in the last slide, then the market is cheap. The market doesn't want to overpay, and it's not going to. If the market thinks that it's going to get the supply it needs for a cheap price, why should it pay a high price? So, I don't really get why there's all these supposed experts that are always saying, "Oh, oil's going to $200, oil's going to $150." Well, who the hell's going to pay it? And so that's what this
Mm,
chart's all about. And it basically just says that, depending on the shape of the yield curve, that reflects something about what the supply urgency is, how much the market feels like, oh my God, we better get busy and raise the price to get some more oil. And right now, that blue curve, which is what rules us, is
yep.
kind of it's sort of a ho hum sort of curve. So you go down on inventory, on supply, on storage a little bit, and the price goes up a little bit. But I don't think we're going to get to $100 is the bottom line. And I know that I'm sort of in a minority on that, but I don't base that on Art's opinion. I base that on data that I've used for half my career.
Right. So this yellow line is 2021.
That was
And
2020 when we were down in the basement for prices, that we had COVID going on, and
right.
markets were saying, "Holy cow, demand is way down. We're not paying anywhere near what we were paying before." And so we
Okay.
moved down to that orange yield curve. Once the vaccines got invented, we moved back up to the blue curve that we've been on since 2017. And that's,
I
what
see.
you can see, that arrow that says November 26th. I've got a new chart I made today, but that point was dead square on that blue yield curve, exactly where it should be. It's
Mm,
not a mystery. And we can argue about, this is not meant to be a regression. I mean, we're talking, the market is human. So, the point is there are excursions, and the excursions are all about human behavior saying, gee, I wonder whether we are going to $100, or I wonder whether we're going to $30. It's complicated, but I mean, so is the world, right?
yeah. So if eh, eh, I'm looking at the green dots that says, and then down here it says March through July 2020 price discovery excursion. That's when price is April 24th, got down to $3.32. This is when the futures market got down to negative 38 or
30.
whatever it was.
Yeah. So that was the
And
weekly average for that week. Yep.
so if let's just assume over the next 2 months, we had a spike in oil up to $200, would we see basically the mirror image of this type of curve, but instead of below the normal, yield curve, it would be above it?
Yeah. What would happen is it would climb up to that red yield curve, which was the one that
Way up.
described, yeah, that one. I mean, not
Yeah,
that
okay,
circle, but that red there. There you go. And so
Okay.
that described pricing from about 2011 to 2014. And of
When
course,
we had that big
oil
bull
price,
market. Okay.
yeah, we were over over $90 a barrel for 3 years.
Okay. Okay.
So, I mean, just for the, just so everybody knows, I mean, oil's never been $200 a barrel. I mean,
Yeah.
never. The highest it's ever been in today's dollars is about $150 a barrel, and that was right before the financial collapse in 2008, and that was just for like a week or so.
Okay.
So when people talk about these crazy numbers, it ain't going to happen. So you see where it says January 2014, it's got a little arrow there on a red dot. That's $97. All
Right
right.
here.
Yeah. So, there's some dots on there that got a little bit higher. I mean, some of those in the circle to the right over there, those got up to 105, 110, and they were on either side of the yield curve for sure. They're scattered. I'm
Right.
not going to get into an academic discussion about it, but you see how far away from that we are right now. But yeah, the answer to
Yeah.
your question is that we would see a mirror image of that trail of tears that went down during COVID. It'd go up in the other direction,
Way up
and
here.
we'd be on a new yield curve once things settled themselves out.
Then that yield curve would be far steeper.
Well, that's pretty steep. That red one is pretty damn steep. I don't think we're going to get much steeper, but we could,
Okay.
and
But
at some
that
point we will.
the steeper that curve, obviously that's pointing to a higher price.
It says that with a little bit of change in storage, the price goes up a lot.
Yeah.
That's
Right.
what it
Okay.
says.
Okay, great. Let's get down to the next chart. This is only Permian production has increased since mid 2020.
Right. So this is a big part of people's arguments why the price of oil is going to get higher and higher, because ever since about 2010, U.S. oil, or shale, whatever you want to call it, although only about half of it is shale, it's been the only growth to speak of in the world.
Okay.
U.S. production increased like 4.5 million barrels a day from about 2010 to 2014. So, that's like 5% of the total. And that's part of the reason the prices collapsed in 2014, because we got a little bit ahead of ourselves and produced too much. So the argument is, well, with the COVID deal, you can see where, just look at Permian or any of those others, there was a big drop off. Okay, that was 2020 when COVID happened. Oil
Okay. Really
production
good
went down a
points there.
lot because demand went down a lot, price went down a lot, and so people say, well, look, it's not coming back to that same level, and there isn't all that much money that's going into the U.S. oil business. Therefore, we're going to have this big structural shortage, and look out, because pretty soon we're going to be 125, $150 a barrel. And
Okay.
and the point that I make on this, the argument is, well, it's only the Permian that's been increasing, and all the rest are kind of flat or declining. I look at this and say, yeah, well, that's been the case since 2016. So what's new about this?
Right. Because
You're
I'm
making
gonna
a
put
big
my
deal about
pointer. Yeah. So I'm gonna put my pointer right here on these flat lines and then
it. Yeah,
compare that to this red line that's increasing significantly. Right.
that's the Permian. That's the big kahuna. And so the point is that, well, you guys weren't making that argument 2 years ago or 3 years ago, but in a lot of ways, the argument would have been even stronger back then, because look how steep that Permian curve was, and all
Right.
the rest were just dead flat. So I mean, to
Right.
me, this is I mean, I understand the argument. I'm not saying it's a stupid argument. I'm just saying that you're kind of grasping at straws here. I mean, it's increasing. I mean, what exactly do you expect? Do you expect instant gratification? I mean, it takes time. It takes time to drill wells. It takes time to produce oil, and it takes time to raise money. And so, from my perspective, um, things are moving along just about right, considering that we're still worried about demand. And this Omicron thing came along a couple of weeks ago, and the bottom fell out of every market because because everybody got worried about what it's going to do to global economic activity. We
Right.
started out this discussion, if global economic activity is low, that means you're definitely using a whole lot less oil.
Is it is it safe to assume that because of this additional supply coming online, just looking at Permian, and then
Hmm.
take it to, January of 2020, it looks like from the supply side, we were set up for a downturn in prices even
Yeah.
without COVID. Is that, am I thinking through that correctly, or am I not seeing
Mm.
something?
No, that's genius, George. In fact, I mean, we were seeing a decline in demand and production before most people ever even knew what COVID was. That was
Right.
happening already because
Yeah.
of just the natural cycle of things. And I mean, the oil business, like every commodity business, it's a business of overshoot and undershoot, that
Right.
because there's this huge time lag between a price signal and demand signals and having to go out and get a rig and drill a well and produce the oil, what happens is that the price goes up, and it takes quite a while before the drilling catches up with the price. And then you got all
Mhm.
these rigs running and all these wells drilling, and the price goes down because you produced too much. And you can't just say, okay, we're done, turn off a switch. I mean, you got to finish drilling the wells. You got to keep producing. And so we overshoot and we have too much, and then
Right.
we shut it all down, and we usually we go too far, and then there's not enough, and that's what defines the boom and bust cycles in the oil business. And it's not because anybody's stupid. It's a hard thing to do, to say, okay, we're going to go out and commit billions of dollars to drilling wells, and somebody on your board of directors said, yeah, but I mean, what about COVID? I mean, what about demand? I mean, I'm not sure we're ready to do that. And
Yeah.
they argue about it, and they decide to take an intermediate kind of position. And in the end, maybe it was the right decision, maybe it was the wrong decision. But people don't just, start spending money because somebody thinks it's a good idea. I mean, you
Yeah.
got to be able to justify it, or else your company goes bust, right?
Yeah, another thing that comes to mind is just I was doing a video this morning, Art, and I used the Treasury yield curve as an
Hmm.
example. And right at here, my pointer around August of 2019, it inverted. So you
Right.
can just think, just take yourself back to that day and think about the oil production going to these new, like, nosebleed levels, while on top, at the same time, the yield curve is inverting. And, that, uh, boy, I'm not an oil trader, but I would assume that the smart money was putting some shorts on right there.
Absolutely. Which is why the price went down. So yeah,
Yeah.
we can't, we just can't disconnect oil from the economy,
Right.
and think, it's not like, let's talk about the Broncos Kansas City game, as if nothing else was going on in the world. It'd be fun if it were, but we can't do that because the two are not only intimately connected, they're irrevocably connected.
Yeah. Or talk about them without talking about the quarterback or the coach or
Well,
something.
or the president, or his net zero dreams,
Yeah,
and
or the
it's
rules of
not
the
fair.
game. Yeah, the rules of the football. Yeah.
We have
All
no
right.
rules, right?
So
Yeah. Well,
now we're, yeah.
so this is how much money companies are spending to drill, and it's
Oh, wow.
it's several years. So what you see is that, so the high point was 2019, and there's all the ticker names there on the right. So those are the 16 U.S. oil companies that I follow, that control like 80% of the production.
I
And so they
see.
spent a whole lot more in 19 than they spent in 18, which was more than they spent in 17. And then
Right.
20 came along, and it dropped way down, which is understandable. And then you go to 21, and of course that's annualized based on 3 quarters of reporting, but it's probably pretty close. And you
Yeah.
look at that and say, geez, they're not spending enough money. So that kind of reinforces the argument that some people made in the last slide to say, okay, we're in trouble now, because only the Permian's increasing. All right, and fair enough. It's a cause for some concern. But we go to the next slide then, and we say, well, wait a minute, guys. Compared to the first quarter, same companies, they've increased their capital expenditures by 56%. Again, we don't just, it's not like pushing a button in an elevator and the door closes and you go to the top of the skyscraper. It takes time. But if we step back and take a look at the bigger picture, um, we're spending a whole lot more money in the third quarter than we spent in the first quarter. The other thing that's on this chart is the blue. So the gold is the change in capital expenditure, but the blue is the capital expenditure to cash flow ratio. And so
Mm,
what that's saying is it's low, which means these companies are taking a ton of cash out of the business right now. I
right.
mean, they're richer than they've been in my entire career of watching oil and gas companies. And
As
so
far as the
investors,
yeah, as far as their balance sheet and how solid their balance sheet is.
yeah, they're on average, you know, they're spending less than half on drilling as they're getting out in cash flow. And so
Right,
part of the reason that they slowed down is investors said, "Hey, you guys, we've been listening to your tall tales about shale and how much money it's going to make. Where's the beef? We're not
right.
seeing any returns." And so the oil companies are saying, "Okay, we'll show you." Now they're showing you. Okay, so they're saying, "Where's the money? Send us money and we'll drill more." And so this
Right,
is just kind of it's like a negotiation. It's a Bach fugue. The organ plays a little bit and the strings play a little bit, and we've got to come to some agreement. The investors and the companies have to figure this out, and and
right.
and they are. But we got all these sky are falling kind of people that think, oh no, we're going to have no oil, and oh no, the price is going to be $200 a barrel. And I'm not discounting their concerns. I'm just saying there's another way to look at it. And if we go
Yeah.
on to the next couple of slides here, this is the weekly net flows into energy focused funds.
Mm,
And you can see that, I mean, this is weekly. And so, we've been this is just goes through the end of October because that was, the data available to us. And this is not my data. This is a company that does this kind of stuff. I mean,
right.
we've been seeing flows of $750 million a month going into these energy focused funds, whereas for months and months, there was money going the other way. So
Mm,
does this say there's nothing to worry about? No, of course not. It says here's another data point for you. It kind of reinforces the fact that the companies are spending more, production is going up, and so is the sky falling? Well, I don't know, but it doesn't seem like it, but
yeah, right.
still cause for concern. So let's look at the next one. Similar kind of deal. So here we're looking at junk bonds. Okay. And
Right.
junk bonds are a good way to raise money. And what we see here is that the amount of junk bonds that have been bought in 2021 is like way higher than anything in the last 6 or 7 years. All right. So what this says
Right.
is that you got people putting money into energy funds. You got people buying junk bonds. You got companies that are drilling more than they were in the first quarter. This is the way of the world. This is how things really happen. They don't happen with a snap of the finger. They happen slower than human beings would like them to. But I don't know, George. I'm just having a hard time saying that, I think there's going to be a crisis for oil supply.
Right. So it's like it's probably not going to 200, but it's probably not going back to 30 anytime soon either. It's kind of
In
seems like
fact,
it's
it's
just a shade
probably
of
not
gray.
going to 50 anytime sooner.
Yeah,
We've established kind of a floor based on OPEC and demand. But
right,
then there's this world, which is, this is global supply and demand. Supplies in blue, demands in red. And we can argue about how much do I believe these, and the answer is, I don't believe anything that isn't happening today, but it's a good place to start talking.
yeah, right,
And what this all says to me is that, yeah, it's true that demand is going up, and a lot of people who make this argument for tight supply say, look, we're going to be at 2000 at pre-COVID demand levels by sometime in the coming year. And that's
mhm,
very true. And oh my God, that means that demand is back to where it was and we're not going to have enough supply. Well, true and fair. But, I just drew a dashed line and said, well, that's the trend line that we were on. And even
right,
when, assuming we do get to pre COVID demand levels, first thing is we're still way short of where we should have been.
yeah,
And
right,
secondly, what's the separation between supply and demand? It's not very damn much, right? It's nothing. It's not anywhere near what it was, for instance, in 2021, the year we're finishing out. Look at the separation between the red and the blue in the right under the word demand. Okay, that's right
mhm,
now. What's the price of oil? Well, today it's about $73. And you're
right,
telling me that it's going to go to 150 or 200 because of what?
right,
Because those two curves are going to move closer together? Um, I don't know. That doesn't sound right to me. Again, markets are cheap. Why would they pay that much? So, again, I'm not trying to say that the people who are making these arguments for tight supply and higher price, I'm not saying they're wrong. I'm just saying that they're kind of looking at this from a through a very narrow window or lens. They're
yeah, right.
you got to back off and say, let's look at the whole picture. Let's look at the whole thing. And the whole thing tells me, is there cause for concern? Of course, there's cause for concern. Is it time to jump out a window? Not by a long shot.
Yeah. This, I've been doing a lot of research over the last few days on the yield curve, not only the treasury market, but I had a conversation with our good buddy Jeff
Mm,
on Friday, and he was talking about the euro dollar futures curve and how if you go out to 2023, it starts to get inverted all the way out to like 2026. And if
yeah.
you look at the treasury yield curve, it's not inverted by any stretch, but it has flattened dramatically over the past, call it, month or two. So when you look at those two yield curves and then you say, hear what you're saying that, okay, the price of oil might go up a little bit, but it's probably not going to go to 100 or 150 anytime soon. It sounds like that's really matching up with what the bond market and the Eurodollar futures market is saying as well.
It is, and there's a key linkage there, and Jeff may have mentioned it, and it's called inflation. All
Yeah.
right, and so I don't have in this particular post that you're showing these slides from
Yep.
an inflation chart because I just had it in the one before, and so all my subscribers, know about it. But the correlation between the price of oil and inflation in the U.S. is so tight you can't even stand it.
Really?
Which is another way of saying that there are many causes for inflation, but if I had to choose the most important one, it would be the cost of energy, and that makes total sense back to where we started this conversation. that
Here we go. Is
uh,
this maybe I think I might have just given us something for the viewers just to kind of get a idea of what you're talking. Oh, shoot, it's not pulling up here. It's probably too small, but I don't, can you see this? So we got crude
I
oil
see it
compared
fine.
to
Yeah,
US.
yeah.
Yeah.
There you go.
Yeah, that's the
So I mean,
correlation
that's
you
an
were talking about.
annual kind of deal. I mean, if I could share my screen, I could show it to you. But it's a killer, an absolute killer correlation,
Yeah, right.
and that's what
Right.
you'd expect. I mean, if the cost of energy is going up, and the latest data point was 6.2% was the last U.S. inflation rate. And what's
Mhm.
inflation been for the last 5 years? Has it been 1%? I mean, so we've got a spectacular increase in inflation, which, I mean, we just said it and showed the data. The weekly price of oil was $3 in April of 2020, and now it's almost 75. So, the when the
Right.
price of energy goes up, the cost of everybody's doing business goes up, and therefore the cost of goods and services goes up, and that's what's called inflation. And so the economies of the world are starting to slow down because of inflation. Now there are
Art,
many other reasons. Go ahead,
what
George.
I was going to ask you, I know the price of oil skyrocketed in the 1970s. But another
Yeah,
thing that I've been trying to think through with the help of, our good friend Lynn Alden
yeah.
is comparing the type of inflation we had in the 1970s to what we had in the 1940s. And her base
Mhm.
case is that the 2020s will look, fundamentally more like the 1940s than the 1970s as far as any consumer price inflation we may see. So, what was oil doing in the 1940s? That what was you? I don't know if you remember a CPI chart, but in we had these three massive inflation spikes in the 1940s. One at the beginning during World War II, one around 19, I believe it was 47, where inflation got up to like 19%, but it came
Mhm.
right back down. And then right at the end, I think
Mhm.
maybe going into 1950 or 51, we had another spike with the Korean War. So, what was oil doing during those times? Did we see that same correlation?
Yeah, that's I can't answer that off the top of my head. I've got a chart that shows that. I think it goes back only to
But we do know it
1950.
it showed the same correlation in the 70s. Is that correct to assume?
Well, when Paul Volcker became the Fed chairman in 1980, he pushed Treasury rates up to 18%. Right?
Right.
Remember that? I do because I bought a house that year. Yeah, I was paying 14.5% interest on a 30-year mortgage in 1982. So
Wow.
um, that was the direct result of the oil shocks. The
Yeah.
biggest one was 1979, 1980. So the two go. I'm fascinated by what Lynn's working on, and I will go back and see what I can put together. I don't think I've hardly ever made a graph before 1950, and the reason for that is there just isn't a lot of world data
Data.
on
Right.
oil. But I'm interested enough. I'll give it a try because that's fascinating. Really good. Really interesting stuff.
Yeah, if you dive into the data, just DM me on Twitter and we'll get you back on to talk about it because I'm really
Okay.
interested to see what you come up with.
Well,
All right.
and I think that is the key, though. I mean, we probably got somebody to talk to, but I mean, people have lots of ideas and lots of opinions. If you go to the last sentence, I think of that post,
Yeah, let me go back
um,
here.
I said something to the effect of, yeah, what does it
When the
say there?
popular
When the
narrative is
popular
changed with data
is challenged with data,
or challenge it.
we find it is more of an opinion than a rigorous analysis.
Right.
The important yet simple takeaway is that markets are not nearly as suggestible as most analysts and investors.
Yeah. Great point.
And so, we all have our thoughts and our ideas and our views. And what I find is that every time I sit down to write one of these posts, I think I know what I'm going to say. And then I start looking at data harder. And,
Mhm.
I can't just say something because I think it. I got to be able to show it. And what I end up with at the end of the post is often very different than what I started out with, because the data won't let me. It won't let me write what I wanted to write to begin with. So it's
Yeah.
kind of a discovery process for me too. So I'm not saying I'm right. I'm certainly not saying I disrespect people who have different views. It's just this is what the data's telling me for now.
Yeah. Yeah. Boy, I sure wish the people in charge of our institutions and our politicians took the same approach, Art. The world would be a better
I think
place right
that's a dream, George.
now.
That's why
All
we're
right.
not running for office, right?
Yeah. All right. Let's go ahead. Do you have time to take a couple calls? Oh, well, we got one
Of
anyway.
course.
Caller,
Hey
you're on.
guys, can you hear me?
Yeah.
Yeah.
What's your name?
Hey, my name's Tyler.
Tyler,
Hi,
you're on with
Tyler.
my good buddy Art Berman.
Right on, thanks. So I'm trying to understand this overall picture of what's going to push oil prices. And I kind of see it happening with like two main crosswinds. And you could tell me if sounds correct to you or not. But one major crosswind is this deceleration of overall supply of goods and services, right? Businesses slowing down, less trucks being on the road because less stuff is moving. This deflationary impact as a whole. And then I think there's another risk of this new wave of intense governmental policy, which can distort typical price signals, right? And especially if you pair that with the whole ESG movement and people trying to go super green. And
Right.
so I think the hard thing for me is to figure out which pressure is going to win out, which one is stronger. I mean, you look at the governmental distortions that are happening with the whole circus outside of the LA ports, and that's significant. And it's something new that I don't think we can easily see in the traditional price models. It's a new risk, right? So I guess, like Art, in your opinion, does those two main factors seem about right from like a 10,000 foot view as far as like the main pressures on oil prices?
Yeah,
And then
let me
what do you think is going to outweigh the other?
Yeah, let me just kind of try to rephrase that to make sure that we're grasping what your question is. I think that the main question there is because of these supply shocks that we've been seeing in the shortages because of supply chain disruptions, could we see consumer prices go up significantly without the price of oil going up? Is that
Yes,
the
yes. Well,
gist
and
of it?
if there's heavy regulation on oil, perhaps larger taxes, perhaps whatever government distortions you can dream of, maybe that could be a factor which would artificially push up prices, even though they have the ability of trying to meet supply and demand as they usually would.
Yeah, yeah. Okay,
Well,
Art, you want to?
those are some really thoughtful questions, Tyler, and I'll try to wade through them. First of all, let me say I don't think that that green energy is a competing force for oil and gas and coal for that matter. And the reason I say that is that you cannot make a wind turbine or a solar panel without using petroleum to do it. You got to
Right.
mine the metals. You have to. I mean, what is the blade on a wind turbine made of? It's made of plastic, for crying out loud. Where does plastic come from? It either comes from oil or it comes from natural gas. There's no other way to make plastic. All right. What about all the metals? The cobalt, the copper, the steel, just the steel for the casing or the for the solar panel or the upright for the turbine. It comes from iron. How do you mine iron? You mine it with machines that run on diesel. Okay, so you pull the materials out of the ground, and what do? You put them on a boat. You put them on a boat to some place to manufacture them. What's the boat run on? Diesel. You send them to a factory, wherever that is. Let's say it's in China. What's the factory run on? It runs on electricity. What's the electricity come from? Mostly coal and natural gas today. All right, you get the thing made. What do? You put it on a boat. It's running on diesel. You send it to the port of LA and it sits out in the harbor for 40 days or whatever right now. But eventually it gets loaded on a truck. And what's the truck run? It runs on diesel. Have you ever watched a wind turbine be assembled on its site? You probably haven't. You never seen so many diesel powered machines in your life. What about the concrete that has to be poured into the ground? Well, that's made with diesel and coal and natural gas. So the idea that these are two separate sources of energy that can exist independently is nonsense. It's just absolute nonsense. You can't do it. So there's no doubt that renewable energy, green as you called it, is going to grow and fossil energy is going to decrease. I mean, that's just where we're going. Whether it's climate change, whatever it is, it doesn't really matter. That's what the trend is. But the two are not competing with each other, except for dollars. They are competing for capital, at some point, and that's worth thinking about. But I think your real question is the government going to screw this up?
Yeah, I mean, more or less. I think that's been the wild card for just about everything lately.
At least artificially manipulate or distort the natural supply and demand.
Yeah.
Let me just say that for my 40 plus years of experience in the oil and gas business, whenever governments, not just ours, choose winners and losers in energy, the big loser is the consumer.
Right.
Because those guys, they're politicians. They don't, they got the attention span of a goldfish. And what we're talking about here is complex. And complex things just don't sit well with politicians because their constituents don't have the patience to understand it either. So they make, these reductionist decisions like we're going to stop using oil and gas in 2025. Never mind that it's impossible. But, okay, that's where we're going, right? And that's the problem. I mean, that, the government, it's run by political people. They need to get reelected. And so they got to choose something to talk about. And it's got to be simple. And simple, I won't say it's stupid, but the results are often unfortunate. Let's put it that way. Yeah, I think in the end, markets are bigger than politicians. And markets certainly run faster than policy. And innovation runs faster than policy. And so, as quick as the U.S. Congress is going to try to, to regulate, let's say, social media. I mean, the guys, social media is the guys in Congress don't even understand the technology or the basics of it. I mean, those guys are going to be so far ahead of any regulation. They just can't catch up. So that's a weird kind of optimism that I have.
Yep. What I would do is what I would do is because I think what you're also trying to figure out is the government can print money as well. Through stimulus checks, PPP, we see that the dollar amount in the checking accounts of the American households in aggregate total has gone up by 2.4 million. So couldn't that affect the price of oil or affect the price of consumer goods and services? But I think if that were the case, that would show up in Art's curves or in Art's charts to the point where demand would increase, right? So that demand is kind of a reflection of the amount of dollars that are circulating in the real economy. And if the additional dollars are getting out and circulating with velocity, you're going to see that with that demand going up. And therefore that affects those other curves to tell you which direction the price may head in the future. And then with the other part of your question, as far as the supply side, with governments coming in with ESG mandates, as an example, with restricting the additional supply that's potentially coming online, that's going to show up in his other curve because you've got the demand and you've got the supply. So I think what those demand and supply curves are telling us from oil is kind of what they're predicting the government distortions will look like moving into 22 and how it will affect the price.
Yeah, that makes sense.
I would be, if there's a government that worries me more than our own on creating distortions, it's China.
Right.
Because they can do whatever they want. They don't have to have a debate. They don't have to, post videos of, killing AOC or, whatever. I mean, they just do it. And a big part of our, of why there are ships sitting off the port of LA that a lot of people don't know about is that China made this funny decision in 2020 that they were just going to stop buying coal from Australia because they
Right.
were pissed at
Right.
Australia or something like that.
Right.
And which was a completely, I won't say it was a dumb decision. It's just, I'd love for somebody to explain, how you cut yourself off from your principal supplier of, of high quality thermal coal. Well, they figured they could substitute it from Indonesia and, a few other places. Well, Indonesia had COVID and they had a lot of rain, and turns out that China couldn't get the coal that it needed, and it ended up in an energy shortage. All right. So, the simplistic, the reductionist explanation for why there's all these supply chain interruptions is because demand increased too fast after COVID. Well, as with most myths, there has to be some truth to it. But the reality is that China has had to slow down its manufacturing process because it doesn't have enough coal. It had to go to gas. Gas costs more because they're competing with the rest of the world for a limited gas supply. And in
Right.
China, the sellers can't pass that along to the consumer. So the answer is we just make less. So in a way, if all those ships could just go back to China and pick up more stuff, they might not come back as quickly because China's output capacity is way down by self-imposed problems that their government has created for them. You look at what's going on with Evergrande right now, okay?
Right.
I mean, that company, is on the verge of default. And the government is just, I mean, they're not only going to let it happen, they're kind of encouraging it to happen. And you and I, the three of us, can talk about, the economics of building cities with no people in them, but I mean, this is going to be a huge deflationary effect on the global economy, and China's not doing a thing about it.
Right.
Now, if that were in the United States, Biden would be calling up somebody to do something because, he wants to get reelected. But Xi Jinping, he doesn't get reelected. He's in, so he doesn't have to please anybody.
Yeah. Yeah, that makes see. It's just there's so many. This is why macro fascinates me. This is why it's been my obsession
Exactly.
since I retired in 2012, because there are just so many variables, and to try to figure out this 10-dimensional Rubik's cube is just it's a never-ending puzzle that I just find incredibly fascinating. So, and those were
And
some
energy
insights
is
there. Yeah, I haven't really thought of before.
energy is always in there somewhere.
Right.
And,
Right.
and once you peel out the layers, I mean, you realize that, oh my gosh, I mean, energy is possibly the first, second, or third most important factor that nobody's talking about.
Yeah. Right.
Europe's having an energy crisis right now. What's that about? Well, okay, Russia's being its usual bad guy and they're not sending gas and da da da. But the main problem is that Europe made government EU decisions years ago that said we don't need no stinking oil or gas. We
Right.
need to build renewable energy. And of course, the sun doesn't shine all that much in Europe. The wind does blow, and the wind stopped blowing for 6 weeks a couple of months ago. And all of a sudden, it's like, oh no, now what do we do? The UK, they shut down all of their natural gas storage capacity in 2019. We don't need any stinking natural gas. We got windmills, and so now they're stuck with their energy pants down. And
Right.
what are they doing? They're burning coal for the greenest place in the world is fighting for coal. They
Right.
couldn't use natural gas if they had to. They got no liquefied natural gas terminals to import the stuff.
And
So
out of
you,
curiosity,
you
did the price go up when that happened for them? I
oh
haven't
my
really
Natural
God,
got
gas
that.
yeah,
skyrocketed.
Yeah,
huge.
I
I
guess that
mean,
would be my similar long midterm concern, like if we did something similar over here, you kind of like shoot the gun too early and then prices skyrocket because the supply chains were disrupted in the meantime?
Yeah, so natural gas, just to give you a benchmark, it got to about $6 per million cubic feet about a month ago. In Europe, it was up to about 25 or $30 per million cubic feet, and it's come down a little bit. It's still above 20. So they're paying 3 to 4 times what we are here. And 6 months ago, we were all paying the same. That's the direct result of absolutely atrocious policy decisions. But the good news is those policy decisions didn't happen overnight. It's just the consequences didn't kick in until overnight. I mean, those were made years ago.
Yeah. Yeah. Caller, we'll let you go there. Thank you very much for the
Thank you,
incredible
George.
questions. Yeah. Hey,
Thank you,
man,
Art.
yeah, if you're not producing content, I'd suggest it. You got a great camera and a great microphone.
Thanks. Yeah, that's what I do for a living. You guys take care.
All right. Thanks, Tyler.
Art, how's your voice doing, buddy? Can you take one more? Or should we?
Sure,
should we
let's do it.
there? You want to do one
No,
more?
I'm fine. If you want to do another, sure, George.
Okay, great. Hey, there he is, Anthony. What up, brother? Oh, we can't hear your audio, man. Yeah, Anthony, we're gonna have to take another caller, man. Sorry. Okay. Yeah, Anthony. Hi, caller. What is your name?
Hi, Nicola.
Okay,
Hi,
Nicola, you're
Nicola.
gonna have to turn off your volume because I can hear myself.
Oh, sorry.
Yeah.
Is it better now?
Yes. Test. Okay, yeah.
Yes.
You're on with Art Berman.
Okay. Thank you for taking my call. I wanted to check first. When you said million cubic feet, did you mean 1,000 cubic feet about the gas prices?
I meant million BTUs. Yeah, thank you for that. Million BTUs, 1,000 cubic feet, more or less. Yeah.
Okay. Yeah, like honestly, I have just one question. Do
Sure.
you think that bonds have like anything to do with the current price, especially that yields in like poorer countries are usually much higher, and I feel that they are subsidizing basically the price of oil right now on the market.
So help me. But you got to turn down your volume again.
Sorry. Okay.
Okay, so help me understand how you're connecting those dots between higher bond yields in a place like Colombia, as an example.
Yes, I lived in Colombia. That's a perfect example. So their yield is going up like month by month, and they are like one of the largest producers of oil.
They're government bonds is what you're talking about.
Yes, government bonds. So they have to sell their government bonds, and it's 3, 4, 5%
I
a
see.
10-year, while the United States government is selling the same bonds at 1%. So it's like a pimp game. Basically, they're just getting a 3% advantage. Europe is doing exactly the same with their bonds. Germany has their bonds at minus 0.18% a 10-year. And while they are buying bonds from Serbia, for example, which is 5%, 4 point something percent, 4.2% at 10 years. So basically, they're subsidizing their resources. Does that play any role at the current price? Because I feel that price is very low that it should be.
Okay, but when you say you're referring, going back to our original example, you're talking about Colombia. So what they're doing is they're subsidizing, therefore they have to take on more debt, issue more bonds, therefore more supply, so the interest rate goes up. Okay.
The price is actually going down because they're subsidizing it with their bonds.
Oh, okay.
But are they using that money are they actually subsidizing energy for the people?
Do they does that have any role to play like in a world market of like benchmark of crude oil?
Yeah.
Does it bring price down basically? Because I feel that this price is a little too low.
Oh, because maybe Colombia takes the money that they're getting from the bonds to create more supply of oil to put out onto the market. Therefore, if they weren't subsidizing the production of oil that would increase the price in the world market? Hopefully, I've got the question right. Do you think there's something to that, Art?
Well, Colombia is a minor oil producer. I mean, it's a big oil producer as far as South America goes. Colombia and Ecuador, of course. Venezuela is the huge potential producer, but they've got that country so screwed up that they can't hardly produce anything. But my sense is, and with respect to all of my friends in Colombia, I visited there several times. I know George has lived there. It's a relatively minor source of world petroleum.
Right.
So whatever, I mean, I don't know what the government is doing with their bonds. Maybe they are subsidizing oil production. I don't think it's enough, to affect the global price of oil. Now we could talk about, is it affecting the cost of living for Colombians, and that would be something very serious and of great concern. A case where government policy is making things worse for people. If things are costing more, then the demand for oil in Colombia is going to go down, because one of the first things to go when prices get high, people drive less. I mean, it's easy to cut back on gasoline consumption and even diesel to some extent. It's much harder to stop using coal and natural gas for heating, for light, for computers. So they're elastic and inelastic demand parameters for different uses for fuel. And gasoline and driving in your car is the most elastic. But the bottom line is that no, I don't think countries like Colombia or Serbia or Croatia, whichever, I don't think those countries play a big enough role in global production that their bond rates are going to affect the global price of oil very much.
Yeah.
And again, I say that with respect. I don't mean to diminish the significance of those resources to those countries.
Yeah. All right, caller. Thank you very much. Very interesting question.
Yeah, for sure, Nico. Thanks.
All right, Art, we'll go ahead and leave it there. I want to wish all of the viewers, we've got, we had about 750 people on live listening
Very
to you.
good.
So I want to remind all those people to enjoy the rest of their afternoon or evening. Make sure you're always standing up for freedom, liberty, free market capitalism, and we'll see you on the next video.
Thanks, everybody.